Alrighty, so let's talk about some stocks I bought this week. Okay, first up, AMD, bought 325 shares of AMD, $35,000 worth. Bought $13,000 of E.l.f, 150 shares there. Nike, 28 shares, $2,000 worth there. Right, all three of those stocks I love for the long term. I think they're all gonna. I think if we fast forward 2, 3, 4 years in advance, we're gonna be like, dang, that was some deals he got there. Those were some great buys. Maybe I'm wrong, and I can accept that, but I don't think so. I don't think so. It was a big moving day for me in the public account yesterday. Big moving day, okay? I cashed some Meta shares, right? I cashed some Tesla shares, and I cashed some Palantir shares yesterday, right? And I went ahead and bought Nike, 625 shares there. I bought 624 shares of AMD. I bought 1,444 shares of Celsius. I bought 405 shares of Monster. I bought 200 shares of Estee Lauder. Now, do you notice what's going on here? I'm selling some of the loved, right? Now, keep in mind, let's go back in time. Let's go back in time. This is going to be fun. Let's go back in time 2.5 years ago. Alrighty, we're back in time 2.5 years ago. Before 1000X. Okay. What were some of the, if I asked you, what are some of the most hated, trashed, talked about stocks in the stock market? What would you say? You would say Meta. Meta would be number one. Most hated, most trashed stock 2.5 years ago. You would say Tesla. And who else would you say? Oh, that one stock that was $30-something and fell to $6. Oh, it was something like Palantir? Palantir? Oh yeah, that one. So isn't it funny? 2.5 years ago, the most hated, vilified, trashed on, kicked while they were down stocks in the stock market. And now, they're so loved. Look where their stock prices have done over the past 2.5 years. Unbelievable. Simply unbelievable, right? So now you see me taking profits here and there on those, right? And what am I positioning money into? Oh, some of the most vilified, hated stocks in the stock market that have great business models that are going to be prospering in the future, right? And these stocks are just kicked and kicked and kicked down right now. Nike, AMD, Celsius, Monster, Estee Lauder, E.l.f. It's all the hated stocks. All these companies, look at their business models over the last 10, 20 years. They're phenomenal. And they're going to be way better in the future. But right now, for one reason or another, people don't like these stocks and they vilify them. They say they're trash. The same comments I got years ago when I was buying Palantir. The same comments I got years ago when I was buying Meta. And you know what I used to say? I used to, compare Meta or Palantir to this company and that company. People used to say, oh, well, they're not that company. They're trash. Quit comparing them to that company. They're trash. And now, when I compare other companies to Tesla, Palantir, and these other stocks, you know what they say? Oh, those companies are trash. Don't compare them to Meta. They're trash. Don't compare them to Palantir. It's literally identical. It's identical. It's just history repeating itself again and again and again and again. And I'm like, okay, talk to me in a few years. Talk to me in a few years. You know what's interesting is I think a lot of the people that used to trash Meta back when I was buying Meta and Palantir and Tesla and those sorts of stocks, right? I think a lot of those people are gone now. Like I never see them anymore. Like they were happy to trash those stocks back then, but man, that's crazy. That's crazy, right? Crazy to think back now. Isn't that funny? So anyways, it's a rotation game now, right? I'm taking profits in the loved now, and I'm moving money into the vilified and the hated now at this point in time that also have great futures in front of them that are going to make me lots of money over the next few years, right? And that's where the thing you got to understand, it's where a lot of times you make the most money. When you can find companies that have business models that have done very well over the last 10 years, but they're going through a tough patch, a 1 to 2 year tough patch, right? And you can find those stocks that are just beaten down, no one wants to own them, and they just got relentless selling pressure on them for 12, 24 months straight, right? When those businesses turn, right, which is what great companies do, they turn around and next thing you know, their revenues start going up again, their margins start going up again, their net income starts going up again, their earnings per share start going up again. What happens? the buying pressure comes in and it's intense because you already had everybody that could have possibly wanted to sell that stock had 12, 24, 36 months to sell that stock. And so when the buying pressure finally comes in, it's only the very strongest hands left. And those people have already been through so much that they don't even care. When the stock starts going up again, they're not very fast to rush to the exits, which puts more and more buying pressure on it, and it gets very intense. Like think about Meta. Meta's a great example. Everybody who could have wanted to possibly sell Meta sold Meta in 2022, right? Everybody. And then when the buying pressure started to come back in that stock and the business model started to turn around, it went up rapidly. It went from 88 to 170 and doubled up like that. And then it went from 170 to 340 and doubled up like that. And then it went from 340 to 680 like that. And now we're talking about a stock that's 700 plus. That's on its way to 1,000 over the next year or two, right? And so understand that's where a lot of times the most money's made in great business models that are going through a tough time. The stocks are beaten down to a pulp. They're down 60, 70, 80%. You go ahead and find those opportunities. You invest into them. And catch a fallen knife. Like people say, you shouldn't catch fallen knives. I've caught a lot of fallen knives and it's worked out really dang well. It works out really well. So my strategy works. Like I don't know what else to tell you other than it works really well. Now, if you want to compare returns over the last 5 years, we can compare it. I'll show you the public account. You show me your account over the last 5 years. I think it's going to be hard to keep up with me over a 5-year span and over a 10-year span. I cannot wait till the public account has 10-year returns. Oh my gosh. I cannot wait for that, man. And so the moral of the story is I like to catch fallen knives in great companies, and it works out very darn well. This is what the public account's looking like now at this point in time, right? We have obviously Meta's the big dog in the portfolio, followed up by Palantir, followed up by Tesla, followed up by Amazon, followed up by PayPal, right? PayPal is kind of somewhat hated again a little bit, but not that bad because it already went through its major hate cycle. I'm up $48,000. I can't complain, right? And by the way, PayPal is a buy right now. AMD, huge buy right now. I'm up to 5% weighting there. Cheesecake Factory is looking really good. The great thing with Cheesecake is it's gone up quite a bit, already up 37%, does not include dividends, but Cheesecake's still a buy. Like that's the thing with cake. Like that stock's still a buy. And it's an easy buy too, as long as you got a long-term outlook. Who cares about whatever happens next quarter, blah, blah. Like at the end of the day, like they have two massive growth restaurant concepts that are just going to be expanding all over the United States of America with North Italia and Flower Child. Like, dude, that company's, they got it made. Like, could you say, a recession comes in and hits them? Sure, that's always possible. But at the end of the day, people have gotten so used to eating out that it's so ingrained in like the culture now that people are still going to just eat out. Like you can look at the huge inflation we had, right? Massive inflation. And guess what? Even after all that inflation, the consumer wages going down, all that stuff for a couple of years, like people still went out to eat. They still did. Like they still made it through, right? Nike, followed up by Celsius, followed up by Revolve, Fubo, Estee Lauder, E.l.f, followed up by E.l.f, right? This is a really good pair investment I like right now. I think it's a phenomenal concept right now to be buying heavily Estee Lauder and E.l.f stock and doing that over this next, few months, if not this entire year, because I think that's going to set up very well long term. You got to understand, like Estee Lauder and E.l.f are going to be around and probably way more relevant 10 years from now than they are today. And so I love just the concept of buying them both simultaneously, right? And then prospering on the other side of that. SoFi, SoFi, just a beast. Already up 113% on that. And they got Monster and they got Speculative Planet there, which Planet I'm just kind of waiting on to see what the Florida numbers are looking like there if I'm going to start buying more shares. Here today, made some big buys, $50,000. Bought E.l.f, $28,000 worth of E.l.f. I bought Nike, almost $13,000 worth of Nike, and then another almost $9,000 of AMD, right? So you can clearly see, that's the thing with me. I put my money where my mouth is. I don't just talk about stocks and say, this stock's good, this stock's bad. I put my money where my mouth is. If I say E.l.f.'s a great buy, and I go do it. If I say Nike's a steal deal here, it's easy money, what do you see me do? I go buy it. I don't just talk to talk. I don't just like, that stock's a buy. No, I go do it. I go do it. I put my hard-earned money where my mouth is, right? And that's always been the way I've been doing this since we go all the way back to the days I was making barely above minimum wage at Walgreens and Einstein Bagels. The same game plan. Where if I see a deal out there, I don't care if I got $500 to buy with, like I did back in the day, back in 2009, or whether I got $50,000 to buy with. To me, it's all good, baby. And I've got a good stack of cash around, So if the market sells off, I welcome that. I gladly welcome that. And I buy every single week. One of the biggest things, what I tell you guys, the most important thing to be a great long-term stock market investor, number one over everything. What do I tell you guys all the time? More income than expenses. It's the key. If you have more income than expenses, you're in a situation where every week or every month, you can buy stocks. You're not a victim to the whole, I need to invest it all right now or I can't. No. You have more income than expenses. You're ready to buy every single week. I buy every single week. And if you can't buy every single week, you need to at least buy every single month. And if you can't do that, you can't invest. If you can't invest regularly at least once a month, your financial life is not in a good enough place yet to even invest at all. You have to be in a situation where you can buy stocks at least once a month, because then you're not in a mentality of like stressing all the time. Because here's the thing. If you told me stocks go down short term, it doesn't matter. It's cool. I'm buying next week. You told me, stocks are going down 2 weeks from now. Sweet. I'm buying 2 weeks from now. You told me, 2 months from now, the stock market's going down. Awesome, baby. I'll be ready to buy in 2 months, because I will be buying in 2 months. Like, that's the name of the game, folks, okay? Always remember that. That's the key over everything before you worry about balance sheets and income statements and P ratios and, SWOT analysis, income and expenses. You got to have more income than expenses every single month, right? Now, I posted this on X. I'm not sure if you guys follow me on X. That's linked in the description area if you ever want to follow me on X, if you use that. Also, my Instagram is always linked in the description area as well, right? But I posted this. I said trivia. No, I didn't. I have a trivia question for you guys. But I posted this. I showed E.l.f, right? I said, a reminder, E.l.f has beaten revenue estimates every quarter dating back to Rona. What? I said, that's truly a generational run. I said, even Mag 7 type stocks can't say that. And here's a trivia question for you. Which Mag 7 stock has actually pulled this off? Because there's only one of them. All the other Mag 7s missed several times revenue estimates since Rona. There's only one of the Mag 7s that has actually pulled this off. You want to know? NVIDIA. NVIDIA is the only one of the Mag 7 that has actually somehow beat revenue estimates every single quarter since Rona, which is pretty insane to think, right? So think about whose company E.l.f is in. They're in the company of NVIDIA. Like, you understand how insane this is? Like, to beat that many quarters in a row. You know how good of a CEO you got to be? You know how good of an executive team you got to be to beat your revenue estimates every single quarter for years? Insane, man. Hey, it's Jeremy. I hope you really enjoyed that clip here today. What you looking at in front of you right there? That's the 6-figure Hall of Fame. Do you want to see the next one? That's the 7-figure Hall of Fame. Now, that is my private group. Those are members of my private group that have scaled to 6 figures, multi-6 figures, 7 figures, multi-7 figures in their stock market portfolio. They say you are the average of the 5 people you associate with. If you're somebody that is having trouble finding other long-term investors that are focused on building their wealth over the coming years, finding like-minded folks, look no further than my private group. We've got a tremendous amount of people. We're consistently talking with each other, learning from each other, researching companies together, sharing news about our different companies, right? We do all that inside my private group. If you would like to apply to join us in there, go down in the description area. There'll be an application down there. You can click on that and you can apply to join us in there and take your game up to a much higher level and associate with the type of folks that you actually want to associate with. You got to understand, E.l.f.'s business model as of today, far majority of the revenues come from where? United States of America. I can tell you that's going to completely flip over this next decade. Over this next 10 years, the far majority of revenue will not come from the United States of America. It will come from international. You know why? Because there's a lot more people that live outside the United States than live inside the United States. And to buy e.l.f.'s products, you don't need to be rich. You don't need to be a millionaire. You could be anybody and buy their products. And so what you'll see, if we were to fast forward to 2035, you'll see a complete massive flip happen with this business where the far majority of their revenue, of their profits, come from international, not from the United States. So that is something to keep in mind here in a very substantial way. And there's so early days in this international opportunity. Like we're like second inning in the international growth cycle. Like we have a lot of this game left to play at this point in time in regards to international, right? Now, the beautiful thing with e.l.f. products, no pun intended, is the price points, right? They undercut the category so significantly when it comes to price. And they have gone up in price, over the past few years, but still, even to this day, the product is so affordable compared to most companies, which means e.l.f.'s going to be strong, regardless of the environment. I mean, look at all the inflation we've had over the past number of years. And look at e.l.f.'s numbers. They're still phenomenal, right? Have a recession, e.l.f. will still put up good numbers. That's the thing. This company, regardless of what you throw at it, you throw anything at this company, they handle it. Throw tariffs at it. They've been paying 25% tariffs for a long, long time since Trump, did the whole tariff situation back in 2018, which seems like 100 years ago now, right? They dealt with that, got through it to the other side, right? Trump does a bunch more tariffs. They'll get through it to the other side. We'll talk about that in just a moment. They actually have a game plan for that. But this company's good in any environment. And I appreciate that. And you're going to understand there's a lot to be said when you're putting your hard-earned money toward a company that it's like, what if things got rough? What if unemployment went up a bunch? What if this happened? What if that happened, right? How many companies can really be good in any environment? There's not that many. e.l.f.'s one of them. No, additionally, this is according to Civic Science, number one most purchased Gen Z brand, number one millennials most purchased, number one Gen Alpha most purchased, right? Listen, this means e.l.f. is in the ultimate pole position for the next many decades. Everybody gets caught up in the short term in regards to e.l.f. and, oh my gosh, the guidance, it was a little bit below what we thought here. We're talking decades here. Do you know how valuable it is if you're the number one brand to Gen Alpha right now? If you're the number one brand to Gen Z? If you're the number one brand to millennials? Do you know how valuable that's going to be over the next 10, 20, 30, 40, 50 years? We're not talking over the next 10, 20, 30, 40, 50 days. We're talking over the next decades. Do you know how much money you're going to be able to make long term? Like, that's ridiculous. Ridiculous. To be the brand? Oh my gosh. I hope people really understand the long-term opportunity here, because it's just ridiculous, right? Now, additionally, if you look at net sales growth outlook for the fiscal year 2025, 27 to 28%, right? For the second half of their fiscal year, which are now going in their second half of the fiscal year, talking about 14 to 16% growth, right? They're coming off a ridiculous comp. They had a 77% number up in the second half of last year. I mean, dude, this is ridiculous. Like, they're comping against such a ridiculous number, right? But what's going on with e.l.f. is the same issue that is going to start happening with NVIDIA, and everybody's already starting to worry about with NVIDIA, right? What I always tell you guys in regards to NVIDIA, I said, NVIDIA is putting up such ridiculous growth rates that when the growth rates slip, people are going to freak out. Exactly what we've seen with e.l.f. now. The growth rates have slipped, right? 77% growth, 15% growth. They're talking about, which once again, they'll probably come in and beat that, but let's just take it for what they said. 15% growth, 77%. Everybody freaks out, sells the stock, panics, right? Same exact thing would happen with NVIDIA if NVIDIA came out and, all of a sudden it's going from 100% growth and 70% growth to all of a sudden, 20% growth, 15% growth. People are going to flip out. Oh my gosh, it's all crumbling. But the difference is with a company like e.l.f., right, is people still keep buying this product over and over and over again, right? People aren't going to mess with their CapEx budgets. And if people are in tougher times, ultimately, they're going to gravitate toward a brand like e.l.f., right? Now, the whole tariff situation, I think they did great by having a slide prepared for the whole tariff questions and whatnot. So what is their playbook if Trump is doing tariffs, right? Here we go. One, supplier concession, so get suppliers to give them better pricing, right? So the supplier takes part of the hit on that. Two, cost savings. The company can always find cost savings. That's just what you do as a company. There's always cost savings to be had out there. 3, price increases, right? The thing you understand about E.l.f., like if they go up 50 cents or $1 on a product, it's not going to make the person say, oh, I'm not buying E.l.f. anymore because they went up 75 cents on this product. No, that's not the way it works. But that does change E.l.f.'s margin profile immensely, right? No different than if Netflix goes up $1, people are going to pay that for that Netflix. Costco just went up on their memberships, right? Think everybody's going to revolt and cancel their Costco memberships? I don't think so, right? So same exact thing with E.l.f. They go up 50 cents or $1 on a product. It changes their margin profile very favorably, but people don't say, oh gosh, it went up $1, I'm not buying it now. That's not the way it works, because what's your alternative? A less quality product at a more expensive price point, right? Favorable FX rates, they talk about foreign exchange here. Supplier diversification, right? So, if a lot of your product comes from China, you can certainly get maybe products sourced in India, which I do believe, I always believe like the U.S. Do I want to go down that rabbit hole? I don't want to go down that rabbit hole right now. I don't want to get people on their feelings about what actually goes on. But supplier diversification, that's definitely a play. International growth, that helps out immensely as well in regards to tariffs, right? Because they're going to be shipping so much more product to Europe specifically, but even outside of Europe as well, right? So that's a whole playbook there. Now, when you look at their income statement, I call this, half good, half bad income statement. Because if it ends at gross profit, this is like amazing, right? Net sales, $355 million just reported. 270 was expected. So they came in with a very nice analyst beat there. Cost of sales, 102 mil versus 78 mil. So gross profit exploded to $253 million from $191 million, right? Like if we just ended there, this is like an A+ income statement. A+, like banger, baby. But it doesn't end there. And their selling general administrative expenses are, extremely high right now. $218 million versus $160 million in the same quarter last year. Now, so their net income got hit. But at the end of the day, an operating income was 35 mil versus 32 mil, so it wasn't nearly as impressive as it could have been because SG&A is just out of control right now. And I understand that could be a concern, right? But I think the SG&A being out of control is a very short-term in nature thing. I do not think this is going to be lasting. I think they're going to be able to keep that SG&A, let's call it, with very modest increases in future years, while we'll see the revenue far outstrip the pace of growth in SG&A in future years. So if I think about their fiscal year 2026, 2027 in future years, I think, whatever revenue growth we're talking here, whether it's 10%, 20%, 30%, whatever the long-term growth rate is, I think that will be far, far ahead of the SG&A growth. So SG&A might be up 5% a year while their revenue's up 15%, for instance, right? This is just kind of a short-term phenomenon because they got all this massive international expansion going on right now, which is, it is what it is. Like, it's just a short-term thing. And I think if we look at their fiscal year 2026 and beyond, it's really going to be a story around net income and EPS, right? We're still going to be talking revenue. We're still going to be talking market share, but the net income and the earnings per share is what really comes into focus in those particular years. So that's something to keep in mind here, right? I posted this inside the Private Stock Group's Discord chat. I said, as of tomorrow, E.l.f. should be trading at a forward P in the 20s or lower. And that's for a company that's not even focused on earnings per share right now. Real focus is on revenue and market share. That's pretty wild. And it is. Like, very rarely can you get a company trading in the forward P in the 20s or below when they have massive revenue growth for this company, right? And they're stealing market share in a substantial way. Like, that doesn't usually happen. Usually when a company has major growth like that, you have to pay forward Ps in the 50s, 100s or above, right? This one, it's like a steal deal. It's a steal deal here, right? Now, the way I could also look at playing something like E.l.f., right, is play E.l.f. plus Estee Lauder. So E.l.f. plus E.l., right? So you're playing the premier brand that's just executing on a high level, right? Even when they're not executing, they're still putting up insane numbers. And then you get kind of a turnaround play here with E.l., which owns a ton of the more high-end brands. So you kind of get low-end plus high-end. And I love this as kind of a pair investment right now, I would call it, where you buy both for the next many months and just load up on these and hold them for the next 5+ years, right? If not the next decade. Because here's the thing. Are cosmetics going anywhere? Or skincare going anywhere anytime soon? No. Estee Lauder owns many of the best brands in the higher end space, and E.l.f. owns the premier brands in the lower end space. And so as a pair investment, I just think this is a banger to just buy these two companies nonstop for this next, whatever amount of time we get these great deals. Like, however long these two companies are under $100 a share, you buy and you buy nonstop. And you just load up on these two companies, right? Because I think this is just a perfection investment for the next like 10 plus years. The next 10 plus years. They are just both set up in a really, really good position here. So I absolutely love it, right? And the way I think I want to explain this to everybody, right? Because I understand there's got a lot of people that are kind of newer to the market and kind of like, noobs and whatnot that have gotten in the market the last few months and around the excitement from the election, all that stuff, right? That are trying to get involved in this game, right? You understand how somebody like myself that's been doing this on a high level for a long, long time, how I think, right? I think in 5-year timelines. I'm not thinking in 5-day timelines or 5 weeks or 5 months. I'm thinking in 5 years, right? And if we look at the way Fidelity Investment calculates our 5-year returns for the public count versus S&P 500, it's not even in the same stratosphere, right? And additionally, like, come on, bonds, seriously, bonds have gotten a negative return per year for the last 5 years, right? When Fidelity calculates this at 26% per year return for the public account. It's ridiculous. I think longer term. I don't get caught up in all this short-term crap, right? I own a basket of some of the best companies in the world, and in that basket's E.l.f. And there's no debating who's better than them in the beauty and cosmetic space. Name one company. You won't be able to. You won't be able to. And so I think a little further along, I know some people freak out, they panic, all this stuff, right? I'm like, can't even get my heart beating. This can't even get my heart beating. E.l.f. goes down 20%, and I'm just like, thank you. That's a gift. That was a gift I wasn't expecting, but thank you very much for that. I'll gladly take that. So E.l.f. and E.l. right now, man, I just love these as just buying and buying and buying. And, whatever I can get, as many shares I can get my hands on for under $100 of both those stocks, gimme. I'll gladly take those shares off people's hands and talk to me in a few years. And in a few years from now, people are going to be willing to pay ridiculous sums of money for those stocks that right now they wouldn't be willing to pay. Right now, I want no piece of that. Just wait.